Last month, I went over Harry Brown's permanent portfolio, examining how it stacked up in terms of long-term growth, managing economic downturns, and achieving financial independence. What we found was that while it did do a pretty darn good job managing economic downturns, particularly more recent downturns like the dot-com crash and Great Recession, its lower than average long-term returns made it more difficult to reach and maintain financial independence, even on longer timescales, unless we had some pretty aggressive levels of saving to back it up. Today we're going to be looking at another investing strategy that's pretty much on the opposite end of the spectrum from the relatively tranquil permanent portfolio, and that's an all-stock portfolio. Just like the last video, we'll be examining how it performs in terms of growth, volatility, financial independence, and how well it manages to achieve its primary goal, which will be pretty easy in the case as the primary goal is to maximize long-term growth even if it comes at the expense of short-term volatility. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. An all-stock portfolio can take on many forms, as its only real requirement is that all of the money be invested in equities. So if you want to invest in individual companies, you can. If you want to spread your money across one or two sectors of the market while ignoring the rest, you can do that too. However, since we discuss index fund investing so much on this channel, I thought it would be good to know just how well that particular strategy stacks up to the rest. Therefore, we'll be assuming that all of the money is placed in a large cap blend index fund, similar to what the S&P 500 is. With that being said, let's start by analyzing historical long-term returns of this strategy. As usual, to analyze the returns, we'll be looking at a few different metrics. We'll be looking at the long-term 40-year inflation-adjusted returns for every year starting from 1927 through the end of 2019, because again, that's the last completed year I have available to me at the time of this recording. And we'll also be taking a look at how many times the portfolio lost money and how severe those losses were. But of course, we won't be putting quite as much of an emphasis on it as we did with the permanent portfolio, as the main goal of this strategy is just to maximize those 40-year inflation-adjusted returns. Finally, we'll touch on how dependable or trustworthy the strategy is by examining how sensitive those long-term returns are to when you decide to start investing. So based on the data I have since 1927, the average 40-year inflation-adjusted return for the all-stock portfolio is about 6.5% per year. Its worst-case return was about 4% per year, assuming you began investing in 1969. And I should note that this was the worst returning period by quite a wide margin, as the second worst 40-year stretch returned a solid 5% per year. So that's quite a jump. Its best case scenario was an average return of around 8.9% per year, assuming you began investing in 1933. That suggests that a $10,000 investment would grow to, on average, around $124,200 over the course of 40 years, after adjusting for inflation. At worst, you're looking at a nest egg of around $48,000, and at best, around $302,700. And those results are nothing to scoff at, considering the amount of history we're looking at here. Despite the fact that we're starting to invest shortly before the start of the Great Depression, and despite the fact that we've gone through multiple spurts of high inflation, and the fact that we're doing nothing in terms of continual investing to smooth out this ride and maximize our overall growth, we're still netting between 6 and 7% returns on average. Compare this to other asset classes and you really do start to see a difference. According to the data I have, a total bond market fund would have netted an average 40-year inflation-adjusted return of about 1.7% per year during this same time frame. If we want to focus on government and corporate bonds individually, long, intermediate, and short-term treasuries would have average returns of about 1.3, 1.5, and 1.4% respectively, with intermediate corporate bonds having an average return of about 1.9% after inflation. Gold would have managed about 1.5%. So while it may not be the absolute best returning strategy historically, as some other equity groups like many small cap funds have performed better over the long haul in terms of pure growth, it is still a fair bit ahead of many of the other traditional asset classes. With that being said, let's take a look at some volatility metrics. The average standard deviation of returns was a whopping 18%. Which means that in any given year we can expect that most of our returns will fall somewhere between negative 11.5% and positive 24.5% with this strategy. That is quite a wide margin compared to the more tranquil permanent portfolio, no doubt about it. And just like with any other strategies, there will occasionally be some exceptions, but since this strategy rates a little lower in terms of overall tranquility than what we saw in the permanent portfolio, those exceptions tend to be a bit more common. And the return diversity chart bears this pattern out. Looking at the individual returns for each year in our return diversity chart, we see that roughly 60% of them, or about 56 out of 93, fall within that expected return range. That's a fair bit below the 82% of the returns that we saw falling within the expected range of the permanent portfolio. and that expected range was quite a bit narrower. Of course, the trade-off here is that while the returns are quite a bit more spread out, the averages are also quite a bit higher. There was a total of 30 years, again out of a possible 93, where the portfolio failed to keep pace with inflation in this sample. That's a loss frequency of around 32%, which again is a slight bump up from the 27% we saw with the permanent portfolio. And while the majority of those down years were recovered from reasonably quickly, it wasn't quite as consistent as the permanent portfolio in that regard. There were a total of 10 10-year stretches where this strategy failed to keep pace with inflation. They were the 10-year stretches ending in 1975 and 76, 1978, 9, and 1980, 1982, and 1983, when inflation was very high, and of course 2009, 2010, and 2011 following two major market crashes. Compare this with the permanent portfolio, which had 7 such 10-year stretches, most of which occurred during the late 1940s and early 1950s, and you see the difference. Next, let's talk about start date sensitivity. Start date sensitivity, at least as we're measuring it in this series, takes a look at the rolling returns of the 10 years prior to each individual investment date and compares it to the rolling returns of the following 10 years to see how big of a difference there is between the two. It's a good way to get an idea of how dependable or trustworthy an investment strategy has been historically. And ideally, we want to keep our total start date sensitivity, measured by the difference between the largest underperformance and the largest overperformance, as low as possible. The all-stock strategy is, as you would probably expect based off the wide range of expected returns, not the most dependable strategy. Its total start date sensitivity comes in at around 35.4%, with the largest overperforming decade beginning in 1949 and the largest underperforming decade beginning in 1999. From 1949 to 59, the all-stock strategy averaged returns of about 17.6% per year after adjusting for inflation, which was considerably better than the 1.5% average return it had during the previous decade. And of course, the 1990s were a booming time for the stock market, with the strategy earning roughly 15.5% per year on average from 1989 to 99, but it of course lost 3.8% per year after adjusting for inflation on average throughout the next decade. Compare this to the permanent portfolio, which had a total start date sensitivity of around 16.4%, and you can see there's quite a big difference. But that just about wraps up the analysis of the strategy's returns. Now let's move on to looking how it handled itself during the worst of times. So a crash analysis is always important to do for any investing strategy you're looking at, because it's important to know that if you're going to put your life savings into something, that you'll be able to weather the storms when they come, both financially and otherwise. In these videos, we look at a few different metrics when analyzing crashes. First is how deep the various crashes were. Second is how quickly the strategy managed to fully recover and set new all-time highs following crashes. And third is the Ulcer Index, which basically measures the downside risk in terms of both the depth and duration of price declines. So in other words, it largely combines the first two metrics we're looking at into one number. The deepest crash for the all-stock portfolio was, of course, the Great Depression. From 1929 to 1932, this strategy fell over 55% from its all-time highs after adjusting for inflation. And the price declines would have felt even worse than that in the moment because we actually experienced some deflation during those years, which helped to somewhat preserve buying power despite the losses. From 1929 to 1933, the CPI, or Consumer Price Index, which helps to measure inflation, fell from 17.1 to around 12.9, or in other words, it fell by about 25%. By 1937, the investment had fully recovered to set a new all-time high, but that wouldn't last very long as it fell by as much as 39% between 1938 and 1945 before again setting another all-time high in 1946. However, despite being the deepest crash in this portfolio's history, it wasn't actually the longest. At least based on how the data for this series is set up, which again, looks at the prices of each investment once a year instead of daily or once a month due to the sheer volume of data in the spreadsheet. In the 2000s, we had a pair of major crashes that took over a decade to recover from. Again, from a once-a-year price perspective. Technically, the investment would have recovered during the dot-com crash briefly before the start of the Great Recession if we were looking at it on a monthly basis. But anyway, the highs set in 2000 were not broken again until 2014 based on how we're looking at the data for a 13-year run of failing to set a new all-time high. The Ulcer Index during this time rose to as high as 3.5, though for the entire 93-year span it was often much lower, on average hovering around 1.4. So as you can see, an all-stock portfolio can grant you some pretty impressive long-term returns, but assuming you don't pair it with anything else to ride those returns out, it's going to be anything but smooth. The data shows multiple decade-long stretches where it basically treaded water. From 1930 to 36, it failed to break the highs set at the start of 1929, falling by as much as 55%. It broke those highs briefly in 1937 before going through another 8 years of turbulence where it again set a new all-time high in 1946. Following that was another 4 years of treading water. From 1974 to 85, it failed to break the all-time highs that were set in 73, falling below those highs by as much as 48% at its worst. And of course, from 2001 to 2013, we failed to break the all-time inflation-adjusted highs set at the start of 2000, falling as much as 43% at its worst. So while the returns are certainly impressive and well worth the risk for some people, we definitely do have to consider those risks very carefully. Because the last thing we want to do is find ourselves in a situation where we need the money from our nest eggs immediately at a time when those nest eggs are down quite a lot. But that'll do it for the crash analysis. Let's move on to examining the all-stock portfolio in regards to financial independence. So it might come as a bit of a surprise, but despite the all-stock strategy's comparatively poor performance during hard times, it actually outclasses the permanent portfolio by quite a wide margin when it comes to achieving and maintaining financial independence. Historically speaking, the all-stock portfolio would have maintained minimum safe withdrawal rates of 3.48% over any 30-year stretch. It would have maintained safe withdrawal rates of 3.36% over any 40-year stretch and 3.25% over any 50-year stretch from 1927 to 2019. The worst year to retire using this strategy was, without question, 1929, as that's the year when all these minimums were set. I should note that, as usual, due to the varying nature of individual expense ratios and tax situations, neither has been considered in these withdrawal rates. The median rates were quite a bit higher at 7.37%, 6.17%, and 5.8% for the 30, 40, and 50-year scenarios, respectively. And the maximum rates for the same durations were 12.71%, 11.4%, and 11.02%, all set in 1949. The all-stock portfolio would have maintained a minimum perpetual withdrawal rate of 3.11%. And just so we're clear, I'm defining perpetual withdrawal rate as the highest withdrawal rate that you could have had while still maintaining your original principal all the way through to the end of the data set, even after adjusting for inflation. So if you had a $1 million nest egg when you settled down in 1927, that 3.11% perpetual withdrawal rate would still leave you with at least $1 million worth of buying power by January 1st, 2020. In raw dollar terms, it would be something north of $20 million because of inflation. Hopefully that makes sense. Those figures are actually not half bad. Sure, the absolute worst case scenario was under 3.5%, but there were very few years where the rates fell below even 4%, even during 50-year retirements. And with a more middle-of-the-road scenario allowing for withdrawal rates between 5.8 and 7.3% depending on the length of your retirement, it can get pretty exciting. And this success continues in the accumulation phase of financial independence. The accumulation phase is where we're still putting money away for financial independence, as the name would suggest. The primary metrics here is what percentage of our income we're saving, how do our expenses change over time, how long will we be retired, and how long will it take us to reach FI based on that information and the performance of our investing strategy. Assuming that our expenses changed at the same rate as inflation, and we were planning on a 30-year retirement, and we saved a fairly standard 15% of our income using the all-stock strategy, we would have reached financial independence in 45 of the 93 available scenarios. Now remember, we don't expect a 100% success rate with any of these accumulation tests really, because that would suggest that someone saving 15% of their income starting in 2020 would be financially independent in 2020, which is highly unrealistic. With this test, I'm more interested in how long it typically takes someone to reach financial independence at each level of savings. And in this case, the typical historical investor would have a little under 36 years to wait before reaching financial independence with this strategy. In the fastest case, one would have reached FI in 16 years if they started in 1949. In the slowest case, it would have taken 64 years if they had started in 1956. The 64 years is a bit on the long side for my liking, but we're not being too aggressive with our saving yet. So I don't feel this is too much of a cause for concern. With a 30% savings rate, the numbers improve with a hypothetical investor reaching FI in 69 of the 93 scenarios, which incidentally is every scenario from 1927 to 1995. Those who began in 1996 or later would still probably be well on their way to financial independence today, but they wouldn't have quite crossed that threshold yet. On average, achieving FI with this strategy and at this level of saving took about 27 years. The fastest was 11 years starting in 1948 or 1949, and the slowest was 52 years starting in 1965 or 1966. With a 50% savings rate, the numbers improved still further, with a hypothetical investor reaching financial independence in a whopping 84 of the 93 scenarios, which is just astonishingly good, even at this level of savings. On average, achieving FI with this strategy and at this level of savings took about 17 years. The fastest was just 6 years, starting in 1950, and the slowest was 37 years, starting in 1956, 57, and 59. And finally, with an absolutely crazy 70% savings rate, the numbers improve even further, with a hypothetical investor reaching financial independence in 89 of the 93 scenarios. On average, achieving FI with this strategy and at this level of savings took about 7.5 years. The fastest was a mere 2 years, starting in 1954, and there were quite a few instances where it was achieved in 3 years, and the slowest was 23 years, starting in 1966. So as you can see, the all-stock strategy has very well-defined strengths and weaknesses, and as a result, it is definitely not for everybody. It does produce solid returns over the long haul, and as a result, can help supercharge your trek to financial independence, particularly when you're saving a larger portion of your income, but it is also a very rocky ride. That's arguably the main reason that most of the other investing strategies out there exist. They're there so that those who don't want to experience so much volatility and long down periods with their nest eggs in order to get those returns have somewhere else to go that gets you most of the returns, but with less volatility. And thankfully, investing doesn't have to be an all or nothing decision. Like I said, you can get most of the returns that something like an all-stock strategy will give you, and sometimes even more depending on how long your investing window is, without taking on quite so much risk. And that's one of the things we'll be covering in this series as it moves along. How can you get the most bang for your investing buck while not taking unreasonable risks with your life savings? But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.